Hey, good afternoon, everyone. Welcome back to the channel. We are once again joined much sooner than usual by Mike Coe of YieldMax. Mike, thanks so much for coming back on.
Hey, I appreciate you having me.
Yeah, so the theme of our discussion today is going to be the recently announced reverse splits. So to start off with, I wanted to get your general thoughts on why those were necessary. And I know we were talking a little bit offline about how, in the past, there was talk of like not doing them. I think unless absolutely necessary. And so I wanted to get your thoughts on that and why at this point they were necessary.
Yeah, well, they weren't necessary. They're advisable, though.
Yeah.
So I can't really. My understanding is that there were folks before I arrived on the scene that had responded pretty negatively, I think, to reverse splits that took place in other products. I think you mentioned maybe it was Tesla.
hmm
You had said,
That was the first one. The reception was not great for it when it
yeah.
was done last year.
And
Yeah.
look, I mean, I think I understand why that happens. I think it's because there's a conflation that takes place between reverse splits in any security and reverse splits in common equity for like publicly traded stocks, for example.
hmm
So reverse splits conventionally take place in stocks like that because you have operating results within a business that are maybe not doing so well, so the company itself begins to shrink,
hmm
and they end up with potential exchange delisting. Right? That's usually the reason that the company is concerned about being delisted. That was not the case with any of these.
Right.
On more than one occasion, I've talked about what I view to be the reason why an ETF might engage in a reverse split, and that there's really two, I think, important reasons from an investor's point of view. One is that house account rules, and they will vary from broker to broker, but there can be circumstances where if you have low dollar price securities, usually sub $5, they can impose maintenance requirements. They can restrict access to margin on those securities. So that would certainly be one reason, which is something that almost anyone who uses margin in an account might be concerned about. The other reason, which is something I've spoken about a little bit more commonly, is for those people who engage in option strategies on the ETFs themselves. And I've heard from a couple people, like yourself, who have, a following, who do YouTube videos and things like that, that they do engage in those.
Yeah.
So what would strategies like that be? I mean, if you trade options on a fund like Alti or any security for that matter, generally speaking, you don't see strikes that are much tighter than, call it a half a dollar, 50 cents a strike. So if you think about it, if you have a $5 security and you have 50-cent strikes, that means that the strikes are 10% of the price of the underlying away from one another. And that tends to be insufficient granularity, for people who are doing that. Now, that's not to say that there doesn't tend to be a period of adjustment, because oftentimes after a corporate action, house rules may stay elevated or be raised until the broker establishes that there is sufficient volume, there is sufficient liquidity, that there isn't something else going on. That's usually part of like an automated risk process. But generally, once that happens, then it's going to be better, because the maintenance requirements could go down, access to margin could be restored, and if you happen to trade options, then you do have that improved granularity.
hmm All right. So when it comes to one of our favorites, Tesla, so I actually just sold my own Tesla and I did the math on it, and after owning it for 2.5 years, it was the equivalent of a CD rate of return, basically, in terms of. Well, I didn't reinvest the dividends, in full disclosure. I took the dividends in cash, but I'm still adding up the cash dividends to the rate of return. So when you factor in the NAV decline plus the dividends gained, it's still a positive return, but it's like a CD rate of return. So what would you say to someone in that boat? Because I know a lot of people bought Tesla early on, like 2023.
Yeah, I mean, I think the important thing for folks to remember when they trade some of these securities is that you're selling volatility, right? So what is the ideal circumstance if you own an underlying stock and you're short volatility? The ideal circumstance is that the underlying asset appreciates, hopefully at a fairly steady pace, and that implied volatility remains somewhat elevated, so you can harvest some of those options premiums and possibly appreciate with the underlying asset. In Tesla's case, and we can look at several strategies which indicate kind of the ideal set of circumstances for a strategy like this.
Yeah.
In Tesla's case in particular, I think this was kind of a challenging environment because you had, for much of 23, I think the stock was basically flat. Then at the tail end of 2024, the stock spiked. It more than doubled in a very short period of time, and then almost completely round tripped it. Right. And this was a function of, actually nothing to do with Tesla per se, a lot to do with the founder and CEO, or the founder and whatever he calls himself now. I think he was not technically the CEO at one point, but his involvement with the administration and his decision to go to Washington and run Doge chopped the stock up quite a lot, and you ended up with very high levels of volatility. And if you are short volatility, that's suboptimal. And I think that's what happened there. The stock has appreciated. I think since the tail end of 2022, I can actually do this calculation right here.
The total, over that time.
Yeah. So, the last trading day of 2022 was December 30th, 2022. So, if one had,
are you able to put this up? I can share the screen.
Sure. I can share the screen.
Yeah.
Happy to do that. I think it's probably easier. So let's see. Share screen, entire screen.
Here we go.
Yeah. So hopefully you're seeing this. So if one had, bought it at the end of 2022, and you said you did not reinvest the dividends.
No, just took them in cash.
Yeah. If you had taken the dividends in cash, then you would be up 58.7% over that time frame. And had you reinvested the dividends, your total returns would be up 110.6%. And obviously the share price is, as you pointed out, is down about almost 74%. But your total returns, would have been, we can see how. Well,
because I'm adding the total dividends to, I'm adding all of those up, and I'm taking those, from what I invested, and given, post reverse split and all that, given like the NAV decline, my number I came up with it was like 10%. Then I divided by 2.5. Because it was 2.5 years.
2.5 years. So if that's the case, then there must be some point in here where 2.5 years. So went 2.5 years ago. So you probably bought it right at this local high then, or something like that.
So I did buy at high points. The first time was April of 2023, and then I was buying into May, June, and July.
April of 2023. So that's right in here. Okay.
Yeah.
Well, we can sort of walk through those dates. I mean, if you bought it on, well, that's the end of March. If you'd bought it on the end of March, you'd be up 16.5% if you had simply taken the dividends. But if you'd reinvested them, you'd be up 49%. Let's see. I'm going to go to, I guess, the second then, because that would be the next day. Oops, no. Let's see. What's the next trading day? I'm going to walk it forward here. Let's go up here. April 3rd. 22% if you had just taken the dividends, and 56% or so if you'd reinvested them. Let's see which day you bought, because, well, no, the number's actually going up now. 5, 6.
Yeah, I bought in tranches. I think I did. I'm trying to pull it up here. I did like 10,000 at a time.
Right. Well, we can go through each day of the month here and see what those returns would look like. You would need to see some pretty big negative numbers though to bring these averages down, right?
Yeah.
Because
Let me just show you real quick, and the only reason I'm bringing this up because a lot of people bought at the same time too.
mhm.
And when I started as a YouTuber, they're saying, "Well, you were so bullish on Tesla. That's why we did it too."
Yeah.
So,
Well,
um,
that's not
no, I know. Yeah.
you sure it was 2023?
Here, let me let me show you real quick here.
Okay.
Can you see my screen?
Let me bring this over.
Yeah.
I'll blow that up a bit.
Okay. So
Um,
these
you
were
have do you have dates in there?
no, but they're on my broker. I put them when I did a video. I put them. This was the first tranche that I bought. Um,
Mhm.
and what's confusing, because this was with Ameritrade back then. So when it moved to Schwab,
Uh-huh.
the reverse split kind of screwed up the totals. So instead of like, because it was 2 for 1, so it should have been like 250 for the 500 here. It should have been like 325 for the 650, but it wasn't quite. And that's what I was trying to figure out. But bottom line, basically, I put about 80,000 into it. And then with the total dividends, I made about 61,000 in dividends. So I did calculate that. That's actually a 77 or 70, almost 78% return just on dividends. But what I did, I took the dividends and then I basically added them to what it was worth when I sold it, the price of it. And I came up with 87,448 and then subtracted that and I got about 8,000. So that was about 10%, just an overall return. You see what I'm doing? Just adding
Yeah.
the dividends to the
Okay.
yeah,
So if you're taking the well, here's the thing, right? So if you're
yeah,
taking your total returns, so here's a way to think about it on your
yeah,
total return calculation. This isn't going to make a huge difference to your math,
yeah.
but it's an important thing to think about, which
Hmm.
is let me give you two hypothetical investments. All right.
Yeah.
The first is you give me $100 today, and in 3 years, I'm going to give you back your principal plus whatever returns I get,
Uh-huh.
be they positive or negative. Okay.
Hmm.
In the second one, I'm going to take the $100 and then I'm going to give you monthly payments back that are equivalent to your principal and interest.
Hmm.
Now, when you do the calculation, are these two equivalent, or is the one that's giving you regular distributions a little bit different? And the answer is certainly it's different, because if you did it sort of an argument ad absurdum and we took it out to 100 years instead of a couple months, and you were getting a payment at the end of every year, you still have to factor in the interest that you earn on the cash balance that's been redistributed to you, because that's an opportunity cost, right?
Hmm.
So, in other words, if you put $100 into an investment and it pays you 4% a year in interest, but you don't get any of that money until the very end, that's a little different than if you got, say, 5% a year, but you were getting regular payments along the way, because each of those payments is then also earning interest in
So it's like
cash.
time value of money.
Well, yeah, I
Yeah.
mean, that's why when you look at Bloomberg's calculation, if you bring my screen up again, you're
Yeah.
going to see that it has only two different options for how the total return is calculated. So maybe we can show that. And I just want to make sure that everybody understands this,
Sure.
because you can either reinvest the distributions into the security itself,
Hmm.
right? So that would be this number if you had just taken every distribution and put it back in. So if for every $100 had you done that, you'd have $165.50 now. Or you could have, say, put it into a cash bearing account. That's the alternative, right?
Hmm.
A risk-free rate of interest in this case is 3.8%. I don't know what you get in your money market accounts, but so that's the way you have to think about it, because it makes a big difference whether an investment is giving you regular distributions or not when you do your total return calculation. So a zero coupon bond is not the same as one that's paying quarterly coupons, for example. But
Hmm.
what I'm saying is, I'm still wondering. I mean, you have a lot of numbers on your spreadsheet, but what I'm saying to you is that I'm just struggling to see how that could possibly be correct, because I'm going through every single day of the month here.
Right.
And if you had bought it as badly as you could,
Hmm.
so something's wrong with the math. And
Yeah.
I'm pretty sure that it's not on my end. So your returns would have to be, total returns at worst would have to be in the 40s, which is, 43, 44% returns for 2 years isn't bad. I think that's well above what equities have averaged over the last century.
True.
I mean, it's, the average over the last century is what, 7 or 8. Over the last probably several decades, we've seen better than that, maybe 12.
Yeah.
But 40+% in 2 years is substantially better than that, right?
Here are the dates, by the way. I actually logged into the broker.
Oh, excellent.
And
let's see what.
Yeah, but it has because Ameritrade, when they switched, they had all the like legacy info before the reverse split. But these are the dates.
Okay, great.
Here. So it was April 17th. And you see what I was saying originally, it was 885 shares, but it took it to like 342 for some reason. That might be where the math.
April 17th, 2023. Then had you reinvested the dividends, the returns would be 60.21. And if you just put them into cash, that's 26.5%.
And okay. With the dividends since then.
Yeah.
Okay. Yeah, I think
that's incorporating a share price decline of 74.
I know where I made the mistake. I know where I made the mistake because early on I did a couple of these tranches I bought with reinvested dividends, and I'm counting
Hang
that
on 1 second.
Yeah.
Sorry.
I figured out the mistake though.
Okay.
Yeah. So I'll have to redo it. But a couple of these, I think I did actually buy with the dividends, so I'm counting incorrectly.
Okay.
But yeah,
I mean, look, everybody's entitled to make some mathematical errors once in a while, right? I mean, you're putting things into a spreadsheet, a typo or a missed number here or there.
Yeah.
But yeah, I mean, the returns are better than equities have averaged for sure over that period of time. But I mean, that's not to say that you can't buy a security and it will not have gone down. If you bought Tesla, right after it had that huge run up post-election, right before it plummeted, by 40+% or whatever that number was, when Doge happened and people started burning Tesla dealerships and sabotaging people's cars and going crazy.
Right.
That was a disaster. And by the way, any buy right strategy where the underlying stock falls precipitously, in particular, if it falls precipitously, volatility can chop things up a bit. But
and timing. I mean, like you said, the timing after the election, like that would have been phenomenal timing to really buy low and sell high if you were trying to do it that way.
Yeah, sorry, I've got somebody from the firm pinging me furiously on the side about something that's not that important. I just need to let them know that it can wait.
So you were talking about when they were like burning the Tesla factories. Is that when basically if you were a Tesla owner, you had to get the sticker that said, "No, I don't support Elon"?
Yeah. So I live in a place where it's really common to see. So first of all, we have a Tesla. My wife drives a Tesla. It's her second Tesla. And right about the time that Trump got elected, but I live in Northern California. I live right outside of San Francisco. It became very common to see stickers that would say things like, "I bought this before Elon went crazy."
Yeah.
Or "This is my last Tesla," or things like this, which is kind of interesting because I think there was a lot of people who bought those cars. Number one, because there had been a lot of complaints in certain circles that thought that electric vehicles were going to be a solution to perceived emissions problems from ICE vehicles. Bought them, thinking they were doing the right thing by the planet. I'll let other people debate how much of an impact that actually has, but you would imagine that you should be focusing on, doing the right thing and not, trying to take your frustration out on one person who, by the way, also probably thinks he's trying to do the right thing.
Right.
You know, right or wrong, and we're all likely to make mistakes from time to time. You know, he's out. That seems to have calmed down. I don't see a lot of those stickers going on, but I do notice
Yeah.
that the lot is full, and
Yeah.
they don't seem to be flying off the lot. So
Right.
a lot more
Right.
Rivians in my neighborhood now.
Yeah, I've noticed too. Okay, so before we get to that emailed question
Hmm.
that I was talking about, I'm going to take a couple from the live audience real quick. So
Sure.
this guy, he said, what's to prevent you guys from cutting the dividend after the reverse split? I mean, the dividend should stay the same.
So here's what's going to drive the dividends.
Hmm.
A couple things are going to drive the dividends. One of them is the implied volatility in the underlying stock. So I think there is a perception that the number of shares and the dividend rate are somehow linked. That's not correct.
Yeah.
They have nothing to do with each other. I mean, the traders and the PMs who are managing these things, they don't know how many shares is divided into. That's a logistical issue that's completely separate from them, right? So they have a pool of assets. They own a certain amount of stock in the case of Ulti, or one of the ones that has stocks like Biggie and so on. And they sell options against however many shares they have. At the end of each week, there's a certain amount of money in that fund. And if there are realized capital gains, those will get distributed. If there are realized premiums from having sold options that, you know, have a gain, those will be distributed. This is something I've sort of gone into before, which is this Rick rules issue, which is that these funds, in order to maintain their pass-through status, have to distribute 90% of the, you know, quote, income that they get from whatever source it might be derived. Now, if you happen to hold stocks that pay dividends and you receive dividends into the fund, then you have to, those would be counted in that. Realized capital gains would be counted in that. Options premiums would be counted in that. And interest received on the collateral, which is usually cash and equivalents, also counts, right? So all those things have to be passed back, or not all of it, but 90% or more, or the fund itself then becomes subject to a 30% corporate income tax on those monies that are not distributed.
Now, question, can you revise that, and can that number be dropped, or does it have to be 90%?
No, that's by law. That's the
Okay.
IRS. That has nothing to do with us.
Oh, that's okay, tax law. That's the IRS so it's at 90%.
I mean, we are
to be.
subject. Yeah. So,
Yeah.
I mean, just as a reminder, I mean, of course,
Yeah.
we're subject to rules from the SEC and the respective
Right.
exchanges,
Right.
but we are also subject to tax law.
Yeah.
And
Now,
unfortunately, we don't get to set that.
Yeah.
Certainly, there are some things in the tax code that I wish I could adjust, but
Oh, same. Yeah. No, I get that. I
not
mean,
too many.
there are things. I mean, the underlying's outside of your control. Tax law is outside of your control.
This is one of the
get that.
reasons, by the
Yeah.
way, that we talk about drip. You know, I spoke to Jeffrey Patek about this at Morningstar, because he had said, why don't you retain more and use that to stabilize NAV through time? And I said, you know, we talk about dividend reinvestment as a mechanism to do this. The reason that we don't do it ourselves is because if we realize those gains, and we did that within a tax period, then we're going to be subject. We immediately give 30% of those back in taxes. So it has to. Now, you can imagine if you have a Roth, or if you have any kind of a tax deferred account, or if you happen to be somebody who doesn't have a 30% income tax rate, then you're far better off taking that and reinvesting it yourself. And what you end up doing is you raise the basis in the shares that you hold. And then essentially what you're doing is you're, you know, deferring those gains back, right? So it raises the basis, and then, you know, once and if you sell those shares, if there is appreciation, then you're going to end up paying a capital gains tax on that, long or short, depending on the circumstances. But you know, there are things that can be done that would reduce the distribution and potentially lend more for capital appreciation. You can sell options that are further away from the current spot price, for example. You know, and examples of funds that, you know, Biggie does, the Target 12s do this, for example.
That's a good fund. Yeah.
Yeah, no, Biggie has done very well. Obviously, Soxy and Chippy, these have also done very well. And I expect the Target 25s to do well for similar reasons. So it really comes down to what, the investor prefers. And also, of course, I mean, you have to get the direction right. So, in the case of something like Misty, where MicroStrategy has been utterly annihilated, it would have been far better to have been in winter, for example. So,
Right.
Because there are funds that bet in both directions on Tesla, on strategy, on NVIDIA. And, it's one of the things that I like to point to, just so that people understand how the strategy works and whether there's any reason to do it at all. I think that looking at Misty and Winter, net of this huge decline that we've seen in strategy, is a really good example. And I can actually show this. So
Yeah.
let's just do this. Let's look at strategy first, right?
Sure.
So we have like a baseline. What happened to the stock? So I'm actually going to go back.
I haven't looked at it today. Let's see today.
Yeah, so let's take a look. It's actually up $3.50 today, but
Oh, yay. It gained a few dollars
okay.
back.
So here we are. So hopefully everybody can see this on this screen right here. This was the local high. That date, if my memory serves me correctly, was July 16th. Yep, it was July 16th. Okay. So now what we're going to do is we're going to take a look at the performance of Misty. Oops. Since that same day. And then we're going to look at Winter since that same day. So we can compare the stock to the bullish. Oops, what did I do here? I didn't type that in correctly. Winter. Did I do that? Okay, there we go. So now we can compare how the stock did to how the bullish overwrite did to how the bearish overwrite did, all from the same day, right? And I think that sort of gives us a sense of whether options, is there anything to options overwriting at all, right? In other words, the whole exercise in selling options is that your hope is that you're capturing what they call the volatility risk premium. What I call the volatility, I'm one of them, I guess. What we call the volatility risk premium. And so if we look at strategy is down 58.78%. Oops, no, that's not the right date. I thought that was a little light. It's pretty close. It's down 61.8535% since July 16th. Now you're going to notice something here, and you're going to notice that the total return, whether you're looking at the price change, which is here, whether you're looking at reinvested in the security is here, or reinvested in interest-bearing account these are all the same number. Why? Because strategy doesn't pay any distributions at all, right? So the only return you get is whatever the stock is worth now relative to what you originally paid for it. So that's a decline of 61.85%. Now, if you had bought the stock and sold calls against it, now your returns are down 56.75%. If you had reinvested in the security, which kept going down, right? Or 48.34% if you had just simply taken the distributions and put them into your money market account, right? So strategy is down a lot. Misty is down a lot, but it's also less. And Winter is up, right? So if you'd reinvested in Winter, because you're reinvesting in something that's making a bearish bet, so you're basically pressing a bearish bet if you take the distributions in Winter and buy more Winter. That's up 81.25%, give or take, since that same day. And the dividends reinvested in cash is 65.9. Now, maybe the fairest way to do this is just to say, well, strategy doesn't pay any dividends, so I couldn't reinvest in that stock if I'd bought it. So I'm going to compare strategy to Misty if I had just taken the cash dividend. And sorry, my son who's in Phoenix, he's switching flights. I'm going to just, I apologize. Do you mind if I just send him a message and say, I can't talk?
Go for it. Yeah.
Hopefully their flight is not experiencing any problems. He's going to see his grandmother in Buffalo.
Oh, wow. Since the shutdown's over, hopefully that's all better.
I just took them into the airport this morning. So,
wow. Yeah.
So let's just do a little bit of quick arithmetic, and maybe you can put it into your Excel sheet. But one way you could look at it is say, okay, well, if I put $100 into winter,
Hmm.
I would have 165.90
Yeah.
in round numbers now.
Right.
And
Yeah.
if I'd put $100 into Misty, then I would have 51.65, right?
Hmm.
Remaining. So 51.65 plus
Yeah. So all in all, you had
165
217, 217.55.
217.54. Okay.
Yeah.
And if I had put, obviously we could see that this would have been a complete disaster, right?
My spreadsheet rounds on me.
Yeah. Well, in this case, you would have been down to, just over $38, $38.15.
Yeah.
All right. So that means that you would have earned on a long bet and a short bet taken simultaneously, you would have earned 8.75% in a barbell trade where you were both in a covered long and a covered short, collecting options premium. Does that make sense? That's the $17.50 over the $200 you initially invested.
Mhm.
Right. And that's in round numbers, 4 months. So a little over 8% in 4 months. That's how much you can attribute to the strategy, the overriding strategy.
Okay.
Right.
That's a good,
Because this
yeah.
is up and down. So
Mhm.
now if it would be possible for people to say, well, take a look at Murni, which is the Moderna covered call ETF. And they would say, that thing has fallen apart, as Moderna has, because it's down
That
90%.
one actually, because I remember when we had Jay on, that one went a while. I mean, that was down so low. I definitely expected that one to be, on the list. Oh, while we're at it, by the way,
Mhm.
everyone asked me about Misty. How come Misty wasn't a candidate?
I'll be honest, I wasn't actually in the meeting where the determination was ultimately made, but
Okay.
my guess is that the plan here is to do reverse splits, because I know that Mike Venuto and Jay both had, heard from investors that it was not, that they didn't want reverse splits.
Right.
Here I am, I come into the scene relatively late and say, well, why not? It doesn't really have any material knocks against it. If anything, it's a benefit. So we should be doing it. I think they are probably going to see how these are absorbed by the community, and
Mhm.
just ensure that people sort of recognize why one would do this. Because,
Yeah.
like I said, you don't have to do it, right? So
So
we're
yeah,
not being compelled to.
it wasn't necessary. It was just a choice to do it at this point.
Yeah, I mean,
Yeah.
and I'm pretty sure I've said this on a couple of X Spaces, and I've probably said it on videos like yours. I may have said it the last time we talked. That I think it's the right thing to do.
Yeah.
Now, I also I have my own views, of course, because I'm sort of coming into all of this from the side. Jay has a lengthy background running covered call strategies.
Right.
And so does Mike Venuto in different contexts. I have a lengthy background as a volatility trader. As a volatility trader who's not really thinking about making distributions, when I was working at the hedge fund, we didn't make distributions. When I was working at the prop shop, we didn't make distributions. So this is a little bit new to me in that sense, that from my perspective, I would say, my goal, and I've actually said this on more than one occasion, my goal would be, can we make it so that the underpinning pool of assets that we are writing against, whether they're long or short, so whatever that is, it could be a basket of long stocks, it could be a long short basket of stocks, it could be a bucket of gold, it doesn't matter. From my perspective, what I would love to do would be to have, in the most tax advantage way possible, a pool of assets that would grow at least as fast as the pace of inflation, and hopefully a little bit faster,
Yeah.
and then distribute anything and everything you could above and beyond that. Now, saying that it was tax advantage is a really critical thing, because, as I pointed out, that's not entirely up to the fund manager what they distribute, how or why, because you have to sort of make sure you avoid any tax penalty. So that's why sometimes you need to make that distribution and kind of leave it to the investor to say, okay, am I going to redeploy some of that capital to this strategy or to another similar one? maybe you were in Misty, you get a distribution and you're thinking, it looks technically weak. So actually this distribution goes into Winter. And then you get a distribution from your residual and Misty plus Winter. And you say, I'm going to put more into Winter because it still looks broken, until such time as your view on that changes.
Yeah.
If you have a big diversified portfolio that has, I would call something diversified if it has 20 constituents, preferably not highly correlated with one another in it. 30 is sometimes sort of like the number that everybody thinks of, but you get about 80% of the benefits of diversification if you are not choosing highly correlated stocks with just 10.
Yeah.
Probably 90% with 20. And, the diversification benefits beyond 30 constituents is not that great.
Yeah. While you got your Bloomberg screen up here, I want you to look into this here. So he says if you invested 10,000 on January 3rd with dividends reinvested, you would have 10,862. I think
in what?
I presume we were talking about Tesla, and he's saying SPY.
Tesla.
Would it be 11,371?
Tesla. Okay. And January 3rd of this year?
Yeah, that's what he's claiming. Yeah.
That could be.
We've got some funny comments.
Dividends reinvested 8%.
Yeah. Okay. I guess he's claiming the SPY was outperforming.
That could be.
Yeah.
Well, I mean, there's no question that not every stock outperforms the market.
Right. And then he said,
in fact, I on any given year, I think, it obviously is going to depend. I mean, if you have a broad rally, then you're going to find that, you might have and you're looking at RSP, which is the equal weight. In that case, then you might actually have a situation where on average, the stocks are up about the same as much as the market. But when you're looking at a cap weighted index that's up a lot, most stocks actually are not going to keep pace with the market. And this makes sense because it's being led by a handful of stocks that really crushed it. For example, NVIDIA, right, would be an example. We can actually examine this right now. We can look at, we can see how many stocks in the S&P actually beat the S&P year to date.
Real quick, though, to this point, he says Tesla has 3% in calls, 20% in puts, and the rest in treasury bonds, 10.5% in cash. Anything you would do to improve the ratios was his question.
So first of all, the cash and equivalents are collateral against the options positions. So when you're looking, don't look at the market value of the options to establish the notional exposure to the underlying asset. Look at the combos and then see what that would convert to in share price terms. Let's go through this exercise. Actually, it's probably a useful exercise to go through.
Yeah.
So, and actually, if I should probably pull up. I'm going to pull up a spreadsheet in a separate place here. Go like this. Okay, so just to refresh everybody's memory, the single stock covered call ETFs can't buy the underlying stock. They cannot buy the underlying stock because of RIC rules. What are the RIC rules? That's the registered investment company rules that do not allow the ETFs to have outsized positions, so excess concentration in a single security. Now, this applies whether it is a single stock covered call ETF or it's a diversified ETF. So you'll often see in a lot of funds, you're going to notice that if they have financials, they have less than 5%. That's also based on RIC rules. If you look even at sector-based ETFs, you're going to see that less than 50% of the stocks that are held in the ETF have more than a 5% holding. So you can go and check this yourself by looking at individual ETFs, but you'll see that this is basically about concentration rules as stipulated by the registered investment companies rules that apply to this and all ETFs. So that's the reason why the single stock covered call strategies are using combos instead of the underlying. Okay, so what's a combo? A combo is just using a long call and a short put, if you're going long the underlying, as a proxy for the stock. And this satisfies these rules because the premium associated with this is going to be substantially less than the spot price of the underlying stock would be. Now, you will find that the concentration rules come into play if the underlying asset moves in a huge amount from where it was when the combo was initiated. This is what happened to Misty at the end of last year. I haven't observed every trade that's taken place in Moderna since that was initiated, but I'm sure that's true. So whether the stock goes up a lot or whether it goes down a lot, it's going to increase the value, the market value of one of the associated options positions. So if I'm long a call and short a put of the same strike and the same expiration, then effectively I'm going to buy the stock at that strike if I held it to expiration, no matter what happens. So that's why it is a proxy for the stock. So let's take a look at what those are. So that's going to be the short puts, and we can see we have 16,208 short 470 puts. So 116,208. And we have 13,211 short 450s. So that's 29,419. And I'm sure there's call offsets to those, but let me just double check that there's no other puts in here. I just have to double check. I don't see any. This, by the way, is the overnight. I'm not pulling up the portfolio screens in real time because I obviously can't do that because they're actually trading right now. And that, so that's the equivalent then, 100 share multiplier. So that's the equivalent of 2.9 million shares, right? So we'll just go 100 times, and then we can see what Tesla is right now. This is how you can calculate the notional value. So you figure out the share quantity. And of course, I just screwed that up. I accidentally deleted that. So that's 2 million. I think it was, what did I say? 2,941,000 shares, something like that. So we'll just round up and call it 420. We know Tesla, that Elon likes that number, right?
Yep.
Remember, he said, I'm going to take the company private at 420.
420, right?
Yep. Cheeky. Okay, so that's about 1.2 in round numbers. That's about 1.2 billion, and the assets of the fund are about 1.2 billion. So it's long $1.2 billion worth of the stock, functionally, right? That's what the proxy works out to. So whenever you look at these positions and you're saying, okay, well, how much stock do they own? You just look at the combos, and you can say that's functionally how many shares they are. And you can see that by seeing the same strike and same expiration. Now you will notice, if I'm going to go back to this for a second, because there's something, important here. Some of your viewers may know this, others may not. Notice anything funny about those options right there that I just circled?
Yeah, I see that it's missing some info there. You've got a 0.01.
0.01.
Yeah.
So what's going on here? These are January regular way expiration 450.01 strike puts. And you're saying 450.01 strike puts. I don't see those. That's because these are flexes. They're exchange traded. So they trade like they're on the floor. So they can trade on the NYSE Amex or the SIBO or whatever. But they're bespoke in two critical ways. They usually choose a strike that is a penny above the call that they get. So if you're long the 450 calls, you're short the 450.01 puts. So at least one option is at least a penny in the money at expiration. So those of you who trade options yourselves will know that there is something called pinning. Now, that wouldn't normally occur in this case anyway, because the traders are going to roll these positions before expiration takes place. But this is basically associated with saying that this combo is truly a combo because either the call gets exercised or the put gets exercised at expiration if these are held all the way to expiration. So that's the first thing that's a little bit different about these, is that they choose a bespoke strike that is a penny higher than the call. What's the other thing? These are European. So that's important because what can happen if an option is not European? The holder can exercise the option before expiration, right? That's the definition of an American option.
Yep.
As distinct from a European one. Now, we don't want to violate the RIC rules. So you don't want to have a concentration issue. So we hold the long calls, which means we don't have an issue with early exercise because it's up to the PMs and the traders to decide whether or not they want to exercise them early. But on the short side, it's up to the person who holds those options. So they use European so that there's no assignment risk on these. And that's not to say that funds don't get minor assignments sometimes before expiration. There are people who don't completely understand, when it's optimal to exercise an option. I'll give you an example. Last week, we were assigned, I think, on a 3 lot of NVIDIA at 187.5 calls at the end of the week.
Yeah.
And the stock closed at 182.5.
Mm-hmm.
Somebody didn't wait until expiration, and they saw that the stock was trading 192, and they just exercised the option early.
Yep.
They could have bought the stock in the open market by the end of the day, $5 cheaper. And the traders, of course, joked. They're like, "Of course, that couldn't happen to us on a 1,000 lot."
Yeah.
Right.
Yeah.
Because that would have been nice to make make a quick $500,000.
Now, this is a good question.
Options improperly.
Yeah, since we're still talking about Tesla, was it possible to decrease the treasury amount into more puts and calls for Tesla? I know you said there's a lot of rules and stuff around this.
Well, if you did that, you would be using leverage.
Okay.
I mean, is it possible for there are levered ETFs. This one is not one of them. We're long $1.2 billion worth of the underlying stock here, which is how much is in the fund. So could we do more of these? I mean, we could. We'd probably have to repaper the fund because this one doesn't describe the use of leverage. So if there's a sense that it's not fully invested, that's not correct. It is. And it's easy enough for anybody to check it. I mean, you just take a look at the total amount of assets in the fund. That's the fund net asset value. Or if you have access to something that doesn't give you that, like I don't use Yahoo Finance. Maybe Yahoo Finance gives you the market capitalization if you put in the ticker. Right. If you do that, that's functionally the equivalent of the fund's net asset value. It's going to be very close to it in any case. The difference is that the fund net asset value is reported. So that's the mark to market of all of the securities positions, sort of sum totaled and then divided by the share count. Whereas the market cap is just the share price times the number of shares, right? But in any case, you can see that these things are close. We did the math ourselves, and we said, okay, there's about 1.2 billion in the fund, and this synthetic works out to about 1.2 billion. So, if there's a difference, we're talking about rounding errors.
Right. Now address this idea here. So there's the notion, a lot of concern about the NAV continuing to decline even after the reverse splits. So address this notion that cutting the dividend may stabilize the NAV. This person says if the distributions are cut, price may stabilize, and no point if it keeps dipping after the reverse split. They think 45% distributions are ideal.
Well, that could be, of course, the perfect amount of the, in an ideal sense, what would happen is the distributions would match. Let's assume, for example, that there was no tax issue and that you always had, ready liquidity to make whatever distributions you wished. Ideally, what you would do is whatever the increase in the net asset value was, less some holdback, let's call it, the rate of inflation. So again, we're making assumptions that the managers can do whatever they want. And that one of the principal objectives is not to maximize the distributions, or even the total returns necessarily, but to have an appreciating NAV. Well, yeah, then reducing the distributions, because at the end of every week, you have a certain amount of money in a fund. Whatever you distribute reduces the value of the remaining assets in the fund by that amount. Right. So if I have $1 billion, I distribute $100 million. Now I have $900 million remaining. Right. So the share price is just simply going to be whatever's in the fund divided by the number of shares.
Right.
So, yeah. Does distributing money reduce the net asset values of the fund? Yes. By the amount that you distribute. Just like when you have a dividend with a stock, they pay a dividend, the share price goes down. Why? Because the value of the underpinning assets has gone down by whatever they gave back to the shareholders at that time.
Well, and maybe address this too, because I've seen a lot of people out there say, well, it's not similar to like a company paying a dividend out of its stock. Like they say those are like real dividends where these are, synthetic option premium. So can you address for people that say that okay, one is actually out of the shareholder value, the profits of the company, essentially, versus the synthetic premium.
Well, so here's an example. Let's just take a look at Chippy,
Hmm.
right? So Chippy has been making distributions. Now, fortunately, in Chippy's case, because it has a diversified basket of chip stocks, those stocks have been appreciating quite a lot, and because of by virtue of their sector, they tend to have fairly high implied volatility. So, this has not been around that long. It's been around since the beginning of April. And the share price is up, and the distributions have been supported by the growth in the fund's net asset value. So it actually doesn't make any difference whether you're talking about, in this sense, I think there is one thing that is in common, which is that if the underpinning pool of assets grows by approximately the amount of the distributions, the share price should be completely flat. Right? Does that make sense? So
Yeah.
if you make 1% a week and you give the 1% back and do that again and again, then the share price would be right where it would never change.
Yeah.
Now, if what you do instead is you say, okay, well, if we make 1% in options premiums because the stock went down, but we collected the options premium, so we're going to give that to shareholders. Then you have the decline in the stock price, but you still did, in fact, make the money from the options premium, so that went back.
Right.
Now, if the next week the stock goes up, but you sold an upside call, and you say, okay, well, we're going to give the share price appreciation back, what has actually happened? Well, if the share price declines, if and when they happen, are no larger than the amount of premium that was collected on any given week, then the share price will also remain stable. But if share price declines are ever bigger than that, then what's going to happen is you're probably going to end up with some form of NAV decline. So, in this particular instance, we have an example where the NAV, basically grew faster than the rate of distributions.
Hmm.
But, that can really only happen when you do not give all the distributions back. Because if I always say I'm going to give you any capital gains we get or any premium we get, then that means that if and as the share price declines, that's going to cut the net asset value. So, and that again is partially a function of that tax issue that I was talking about, which is a little bit cumbersome. I don't like it. Now, I think one way that could be handled and might be is that the amount that is actually realized really matters at the end of a tax period, right? So one way that I suppose it could be managed is that if you reduce distributions in the intervening period and then sort of waited to the end to see, okay, can we in fact, did the net asset value sort of hold in there? The only problem then, of course, is that then you could also end up with a situation where you hand people a big check at the end because the gains were more than you anticipated.
Hmm.
And that has its own sort of issues. I don't think people should object to it, but you kind of have to navigate the rules and investor expectations. I think in this particular case, for most of the YieldMax products, these were designed to maximize the distributions on month after month, and then actually more recently week after week. These things went weekly earlier this year. So when everything sort of went weekly, I think the whole idea was we're just going to give people as much back as we can. And then if they want to stabilize the NAV, they can then take their distributions and redeploy it. And you can see that, if you have $100,000 initially invested
Hmm.
and after a distribution, you see that you've got 95,000. And let's say the distribution was 10, you can take half of it and redeploy so that it gets back to 100. But again, I think that's also important that as you do that, do so in a way where you like your allocation. If you're looking at single stock covered call ETFs, remember that what you're really doing is you're buying the stock and selling covered calls against that stock. So make sure you feel good about that stock. That's obviously important, unless it's one of the diversified ones.
Right. Okay, so now I want to go to the question in the email. And I do have the funds that the person invested in.
Okay.
So we can cover that. So I'm going to go ahead and screen share real quick. And this is, like we
If you
said,
see me
tough,
looking all over, it's because I have I have screen here,
multiple
here,
multiple
here.
monitors, right?
Yeah,
Yeah.
I've got it. So I'm just trying to find out
I
where
kind
you
of do
are.
the same. I kind of do the same. That's why I'm always like, when I'm here, I'm looking like kind of like sideways.
Oops, I can't do
Yeah.
that because I was
It's like a
I
mirror.
was just sharing the share, so it
Yeah.
created that Hall of Mirrors effect.
Yeah.
Okay, so I won't do that. Okay, I'll look over here.
Okay. So I'm going to put this up over here, and then I'll just read it. Hold on. Let's see. Where are we? Okay. Here we go. Okay. So he says, "Hello, coach. I have a few questions for the Mike." He says, as an investor since inception, I'm currently experiencing a combined loss of 30,340.88, despite advertised high yield distributions. He's saying the income does not offset the rate at which my principal is being destroyed. This raises serious questions about whether the products may be marketed responsibly, whether the underlying strategy is suitable for any long-term investor. Now, the funds that he mentioned that he's in, let me
Yeah, let's take a look at them, and I guess he gave you some specifics, right, about when
yes.
he invested in them. Okay, so
Uh-huh.
you said YieldMax.
Yeah, that was definitely one. I have the list here. Okay, Tesla, AMDY.
I put YieldMax there. Okay, well, I think we talked about Tesla already,
So
but
there's about 10 of them.
oh, okay,
Yeah,
MDY.
AMDY, AMZ, Aptly, and then he's got YMAX and YMAG,
Okay, I've got so
and then he's also got Biggie, Chippy,
all right.
and then QDTY and SDTY.
All right. Oops, not Canadian. Why did it do that? Big E.
Okay, and then he says,
Okay, so let's you know what? This might be more easily done in a spreadsheet with an API. So I'm going to go like this. I'm going to bring this
okay,
over here.
and then we'll just go because it's about a 10-part question, so we'll just go.
Okay.
Yeah.
Hang on a second. I'm going to let you pull that up while I do something over here, and then
Sure.
I'm going to need. I apologize because you just listed a bunch of tickers. So I know you said AMDY, AMZY. You said YMAX, YMAG. I know you said Biggie.
Yeah, AMDY, Tesla, AMZ, Aptly, YMAG, YMAX,
Okay.
Biggie,
Yep.
Chippy, and then QDTY and SDTY.
QDTY and SDTY. Okay. And do you happen to have entry dates for that?
Let's see. He has been investing since. I don't think he. Let's see. And he says an investor since inception. So
Since
assuming he,
inception. Oh,
yeah.
okay. That's perfect.
So
That's going
yeah,
to be
assuming he
that.
bought them all at
Oh, okay.
inception. Yeah.
On inception date. I think
Yep.
that's the right field. Let's
Yeah.
see if I remember that correctly.
Mm-hmm.
Bring A2. If you don't know what I'm up to, it's just because this is the Bloomberg API. So fund.
Yep.
Inception date is not the right one. So hang on. Oh, it's just inception date? Oh, it's fund incept date.
Ah.
There's thousands of fields. I can't necessarily be expected to remember each
No, you're
and
doing
every
fine.
one. Okay,
Yeah.
so that's going to be this first date, and we'll use today as the last date. So equal to VP. Oops. Let's see if that works. What? I forgot the. So I apologize. You guys are getting to watch this stuff right in real time. I have to put this in here. I think that there we go. Okay, so I've got that down. So I need to make sure that those things don't move.
Bloomberg's great, isn't it?
Yeah, so B2, this one can move. This one can't move. And that can't move. So there's not one of those that is down since its inception date.
Yeah, he's saying that he claims 30. Let me go back to his questions here. We'll definitely, and I'm willing to do follow-ups like with my own spreadsheet. I'm gonna do. I love numbers, so I'm willing to
sure.
there.
So let's just go
Yeah.
over these numbers. So the total
Yeah.
return for AMDY. So the fund inception date was September 18th.
Mm-hmm.
It has returned about 59% total return since then.
Mm-hmm.
AMZY 71%, YieldMax just under 32%, YMAG 57.5%, Biggie 17%. Tesla, well, you guys can see the numbers. I don't know that well, maybe you can't see them, so I'm going to blow those up a little bit.
Here. Yeah.
Okay. And actually, I think it's also helpful that maybe I just say, well, here's how long that has been.
Mm-hmm.
So we can figure out, this is going to be a very crude number, but this is going to be the number of days that this thing has been around. And I need to put a string in here. So that's 798 days. And some of these have been around for lesser periods of time. We'll divide that by 365.25. So that's how many years we're at, basically.
Yep.
That's probably a decent way to, I think we can agree that's a decent way to think about it.
Oh, I see what you do because of a leap year. So it's 0.25 because every 4 years is a leap year.
Yeah, I mean, I should obviously, if I was going to be more precise, because actually every so many years you skip the leap year. It's actually not exactly 365.25 days in a year, but I think for our work, it's going to be close enough.
Yeah.
So if we divide, now this is really very crude. This is not completely the right way to think about it, but it's a decent approximation of what the annualized yield is for these.
Mm-hmm.
So AMD is total returns are about 27% annualized.
Can you make those columns bigger too?
Yeah, sure.
Thanks. Yeah.
So again, I want to make it very clear. It is entirely possible. And I'm actually going to, just so people know what they're looking at, the years, if you can't see that, but I'm going to format this cell. So that's the annualized yield approximate since inception for each of these funds. Total returns.
Mm-hmm.
Now, I want to make it clear that if you buy, I mean, there were days when you could have bought any one of these things where it could be, I don't think any one of them is trading on its absolute highs today. So there's got to be a day when people have bought these things and are down money. Just like there could be a day, on any given stock. But, the returns, the annualized average returns for the ones he just mentioned is 26%. And not one of them is down since inception. So there must be something.
It's a way we're doing the math, I guess.
I guess.
I don't. Yeah.
It could be maybe the dates are wrong. Maybe he didn't buy them on the fund inception date, or he bought them some other date, or maybe he sold them at some other point, or bought and sold them, or like I said, I don't know what everybody has done in their individual accounts. I can only calculate what the total returns are.
Right. Yeah. We'll definitely, because I'm going to even read.
And these are not, again, these are not my numbers.
Yeah.
These are
right.
Bloomberg's numbers.
Right. Okay. Can we go through though his different parts? So he mentions distribution sustainability. So if the NAV continues declining at the current rate, how do you justify the long-term sustainability of the distributions?
You know what I should do? I'm going to do this. Let's do this. Let's also have the price, because this, I think, is a big issue.
Yeah, price
I'm going to put the price. Yeah. So this is going to show the price today.
Mm-hmm.
And we're going to see, because this is, I think, a big part of where some of the math goes wrong.
Mm-hmm.
So J string 1. So this is today's price. I'm going to blow these up.
Mm-hmm.
And I'm also going to have the price as of. As of the did these things trade on the inception date? Sometimes the funds, the first official reported price is from Bloomberg is the previous day. Oh yeah, I mean the next day. So you can buy it on the inception date, but sometimes Bloomberg's price data is. So I'm going to add a day to this. There it is. All right, these ones are not. Why are those not doing that? Okay. If those were launched, I'm going to go and just see whether those were. Oh. Well, all I'm doing, folks, if you're wondering, is I'm just adding the. Okay, so we don't have a first. I might have to use a price chart to figure out why those prices aren't populating. But I think this will help illustrate the point that I'm making, which is that, let's go like this. We're going to bump this up to a nice big number so everybody can see it.
Mm-hmm.
This is going to tell us what the share price has done, because I think when the share price is down from where people got in, that often leads to this thing. So you can see here, AMD, Y, almost 59% total return, but the share price is 60% lower than it was on the close on its first trading day. This one I have to go figure out when Bloomberg picked those dates up. I don't know why it doesn't have those. So you can see that only Chippy and only Chippy and Biggie are higher. The share price is higher. But in Biggie's case, that isn't the highest annualized rate of return, but the share price is higher. So I imagine that most people who bought Biggie are probably saying, oh, this one did really well. Was it the best performing? It was third from the bottom in this list in terms of its annual performance. But the share price is higher. So, depending on... these returns, the annualized rate of returns are, I think they're pretty respectable, and they're definitely consistent with being invested in equities. Now, one of the points I would make is that I'm not crowing because the total returns have averaged about 26% or so, relative to the S&P. I would compare Biggie to the S&P. Some of these others, these other ones, obviously, that the annualized total returns are much better. I would argue they should be, because these are the market's leaders, right? So if you had said, okay, I was going to buy AMD and Amazon, and Tesla's been kind of a bumpy ride, but you would expect to have outperformed the S&P if those were the stocks you bought also, right? If you had put them into something other than a fund that does covered calls on those stocks. Now, it's outperformed the market in most cases, but it obviously depends which stocks you choose.
Right. Okay, so let me just, we don't have to go in order here, but I think he's got some valid, in his 10 parts here. Let's do.
Am I able to see what?
Yeah, let me do this again here, because I keep switching back.
Yep.
So let me just discard this for now. Okay.
Yeah, if you're not sharing my screen, I'm going to go try to figure out what the last price on the first recorded trading day by Bloomberg's data for Tesla and Apple are, because I do not know why.
That's fine.
The data
so
isn't there.
We'll skip to part 10 here. He goes, like, on your website, can you publish like actual investor returns since inception? He says this will help clarify how most investors have fared. The actual and median actual investor return. I don't know if that's a stat. I don't know if that's a stat that's collected.
No, it's not.
Yeah.
So so one of the things, this is an area where I think he's trying to if he's asking us to estimate the median returns for people who have bought and sold securities that we've issued, that's not possible because we don't know what individual people have done.
Yeah.
Right. And nor can we control when they elect to buy and sell. I mean, that would be like asking Jensen Huang, how much, I mean, I know your stock's up a ton, but how much of people who've day traded your stock actually made? Well,
true. That is true.
Well, I would make 2 points about this. The first is that he has no way to do that, nor do we.
Yeah.
But the second thing is his response would be probably, why are you day trading my stock? I mean, if you're an investor, what do investors do? They don't day trade it. I don't know when people bought things and sold things, so I can't calculate the median. Now, that's a different thing than saying, okay, how much overall has been made or lost? Best guess, because you can see fund flows. Now, we don't know how those fund flows go because investors don't interact with us. They interact with market makers, but there are creations and redemptions, right? So when there's a creation, that means that on balance, the market makers have sold enough shares of the ETF that they've decided to create more. And when they create, what they do is they put money into the fund and the share count goes up by the amount of money that they put in, right? So if a creation unit is 20,000 shares, the share count will go up by 20,000 and the net asset value will go up by, that amount of money, right? So it's neither accretive nor dilutive to other shareholders when that happens. So you can imagine you have a fund that's got 1 million shares and they're worth $10 a share. So that's $10 million in the fund. If there's a 20,000 create, then there will be now, instead of 1 million shares, there's going to be 1,020,000 shares. But then there's also going to be 200,000 more in the fund. So instead of having 10 million, you have 10,200,000, right? So that's what we can see on our side. Now, how the profits and losses in those creations and redemptions, or what people have been doing with the market makers, we obviously don't know that, right? There would be no way to know. It's not reported to us. I mean, there is no way to do that. But people can figure out their own P&L. But I can also say, one thing I can do is say, if you bought it on the fund inception date and you hold it today, I know exactly how much you made. And so does everybody else, because the total return calculation, that's not me coming up with that number. That's just what it is.
Right.
If every dollar put into AMDY on its fund inception date is up 58.99% total returns to date. If you had not sold it, 71.23% for AMZY, 31.89% for YieldMax, 57.5% for YMAG. The two worst performing funds he mentioned were QDTY and SDTY, which are up 8.36% and 7.69%, which is 10.7% annualized and 9.6% annualized. That's the worst performing since inception of any of the ones you just mentioned.
Right. Okay, so point number 9, I know we beat this up quite a bit, but
it's not beating it up. I think people are entitled to the facts, right?
And that's the thing. I mean, I keep getting the same questions, so I keep kind of asking the same questions. But distribution versus NAV preservation. Why does the funds prioritize maximizing headline distribution yields instead of preserving NAV for long-term holders?
I think it's in the name YieldMax.
That's what Jay says too. Yeah.
Yeah. I mean, so look. I mean, it is in the name YieldMax.
Yeah.
I like the target 25s, and personally. And the target 12s. The target 12s actually have had significant capital appreciation and distributions as it happens.
Yeah.
I would like to see a fund structured so that you're selling options premiums in a way that does stabilize NAV, because as I pointed out to Jeffrey Patek from Morningstar and to others, by the way, it is not in our interest to distribute money back to shareholders. We don't get paid on money we give back to the investor.
Oh, he actually responded to me live. He said his 30,000, he's down in just YMAG and YMAX alone. So I don't want to we don't have to hash out the math here. I mean, we can
you just
redo it.
If he's watching live, and
I
look,
asked him to join live.
well, no, that's
Yeah.
great. That's perfect. And look, I want to figure out what's going on in his case. But what day did he actually buy it? Because he didn't buy it on the first day and hold it to the current day and take all the distributions in the meantime,
right,
and lose money, because that's not what happened.
Right.
So if he's losing money, he bought it on a different day, or maybe he sold it at a loss. I don't know.
Yeah, I don't know if he said he actually sold anything. But yeah, he said that just those two funds. Interesting.
YMAX
right.
and YMAG. I mean, we can see right here. So
yeah.
YMAX is up 31.89% total returns since inception, and YMAG's 57.5.
Yeah, let me go back to that really quick so I can show that, and then we'll go back to since inception. No, I know, like you said, everybody has access to the same numbers too.
Yeah, I mean, that's right. I mean, these numbers are not my numbers. These are just coming out of the Bloomberg terminals calculation.
Right.
I will issue one bit. Somebody was telling me, and I have not verified this, so take it for what it's worth. Somebody was using a TradingView terminal, and he and I were comparing notes, and we did not get the exact same number. And in one or two instances, the number was significantly different. It could be a rate assumption issue, or it could be a reinvestment issue in that case. In the case of the Bloomberg terminal, we can reconcile what numbers we're dealing with. And actually, so we can verify this, we'll do this right now. I'm going to go to YMAX since inception. And what was the inception date for? We have 60 funds, so I have not committed them all to memory. YMAX inception was 1/17/2024. And by the way, I mean, look, I don't ever want to see any investors losing money. So here's the YMAX numbers, and we can actually see where these numbers are coming from. So this 31.89. So you can tinker. Oops, where's the other side of this thing? I need to. Oh, it's on this screen here. So 32.2 if you'd reinvested in the security, and then the dividends, the reinvestments in Bloomberg, they pull these numbers in automatically, the interest rate, and they actually have access to historical interest rates. So this is the sort of the risk-free money market rate now.
Yeah.
And so these numbers change depending on, you can always just put in, like the number that's in there, 3.8%, that was what it defaulted to. But, if your number was higher, 4.5%, then that's going to change this number. Or if it's lower, let's say you had 1%. I have an Interactive Brokers account. I don't know what the rate is. I'm pretty sure it's not 4.5% on cash balances.
Yeah.
If it's only 1%, then it would have been a 27% return since January 17th, first date. Right. So that if there's a slight discrepancy, my guess is that's where that slight discrepancy is going to come from, is like an interest rate assumption. But you can see that the change is not that big. In his case, he's saying $30,000 loss. And I don't doubt that he has a number somewhere that shows that this is the case, but I am not clear. Oops, no, I can't do that because I'm not sharing this one. I get the Hall of Mirrors effect. Yeah, I don't know. I almost want to sort of talk to him myself, but it's probably inadvisable for me to do that.
Right.
I
Yeah.
could open myself up to that, but I do
No,
want to
I'm
sort this
happy to
out.
be
You know what I
the
mean?
I'm happy to be the intermediary.
Yeah, I mean,
But yeah,
I do want to figure out what's going on here because it doesn't
yeah,
jive. So, something's not right.
yeah. I know with my numbers, I'm not counting a couple of reinvested dividends, so I got to redo those. Um, but yeah, let me go back to because so his general theme. Do you view these as like long-term investments or more short-term?
I think it depends on whether or not you need investments that pay regular distributions.
Hmm.
So not all investors do. I have a son who's going to college next year, and um, I'm not going to be encouraging him to invest in things that pay distributions necessarily. He can have
Yeah.
some, for you know spending money, I guess,
Hmm.
if that's how he chooses to use it. Um,
And that
but
makes sense
if
too.
you're
Yeah.
yeah, if
Yeah.
you're 20 years old and you expect to retire at 65 or 70,
Hmm.
so you're going to have a half a century investment horizon.
Yeah.
Um,
Growth's probably going to be
growth
better
is
for you.
growth should be a big focus, and it is not just a function of age. This came up in a conversation I had last week. My parents are still around.
Hmm.
Fortunately, very happy about that, of course.
Yeah. Oh
But
yeah.
they're older. My dad's 88 years old. Um, so he needs some income, but he doesn't need that much because you know, he's long since paid for his house, right? So they don't have huge expenses. It's not like they're going out to eat a whole lot. And frankly, when you're in your 80s, they don't eat very much anyway. They always
Yeah.
complain about how big the servings are at restaurants.
I'm the
So
opposite.
yeah, I mean,
Yeah.
yeah, we talk about shrinkage, right?
Right.
Inflation and shrinkage and all the other kinds of things that are going on. My parents are like, "How can you eat all of that food?" And
Right.
actually, you look at me. Obviously, I shouldn't.
Same.
Um, I
Yeah.
like food. What can I say?
Yep.
But the truth is that if you're in a circumstance like they are, the income portion of your investments should probably be based on what your distribution needs are
Hmm.
in over some window of time. I mean, there are some types of investments that are paying distributions for a fixed horizon. Um, whether it's an annuity or something like that, and people, they work around their needs, and then everything else can probably be in a longer term. I mean, the thing about long term investments, and that's one of the nicer things about something like Biggie. So if you have a lower need, you can invest in something like that, and it will grow. It's up 5% or whatever since inception in terms of the
Yeah.
share price, which is, I mean, I hate to say it, but that's probably just barely above the rate of inflation. And the reason I say that, and people say, "What are you talking about? The rate of inflation is 2.9%." No, it's not.
No, it's higher.
Yeah, I
Definitely.
mean, that's
Yeah.
just the government, the CPI numbers are just they're
Yeah.
bogus.
I say, go to the store, go look at coffee right now as a good
Ugh.
example. Yeah.
Italian roast. I just switched to French roast with Starbucks. It's
Yeah.
ridiculous. I had a subscription at Amazon,
Hmm.
and it only just noticed it. It just happened yesterday. I got the email and it said, "Oh, the price on your subscription has changed."
Yeah.
And it went on like the 12-ounce bags or whatever, and I get like 5 at a time. And
Yeah.
that I only get the 12-ounce bags because the 28 ones were more per ounce than these were.
Hmm.
And the price went from 9 something to 12 something. It went up by $3 and change.
Yeah.
I mean,
Well, I don't.
30%. 30%. They're just like from 1 month to the next, like, oh, the price went up. So now
Yeah.
I understand. I mean, coffee prices are up a lot, bananas are up. We had some issues with beef imports because I think there was like something infecting the cattle herd in South America,
There's
and that
always
was
something like that. There's always like the chickens with the eggs. There's always some
yeah.
like it's like who's managing this? Like we got to do a better job of
But
this.
CPI, yeah, CPI
Yeah.
is always assuming that people just switch.
Yeah.
It's the most favorable because don't forget that the entitlement programs have cost of living adjustments, so
Yeah.
it's in their interest to understate inflation as much as they possibly can.
I was
Wow.
laughing when the politicians were like, "Well, hey, we got you a 9% increase the year that inflation was its
We
highest."
got you.
Yeah, I know,
We
right?
got you. Yeah, we printed money like crazy. We
Yeah,
blew the price of everything,
right,
you know, out of sight, and
right.
then we got you.
Yeah, 9%.
Great. Yeah, you
Yeah,
borrowed against everybody's future. I mean, that's the
yeah.
ridiculous thing. I mean,
Mhm.
it's it's insane. I hate to say,
Yeah.
but yeah,
They were actually
5% is probably a good target.
yeah, some politicians were actually they were campaigning on the increases, those cost of living increases to Social Security and all the other benefits. Yeah. Anyway, here's a good one. So volatility, what's the minimum implied volatility threshold for the strategy for
Which one?
sustaining distributions? I guess he's kind of I guess any fund. I don't know. He didn't mention it
Yeah, it
specific.
varies. It varies by fund. So for the individual single stock covered call ETFs,
Hmm.
they have their own targets. Let's speak about Alti
Yeah.
in this case, because there are some things that are going on inside of Alti, some changes. This is the one where I have the greatest visibility
Hmm.
because to me, um, I first of all, I was invested in Alti. I ended up selling my position in Alti right before I joined officially because when you work for a financial firm, oftentimes they impose restrictions on your ability to transact. I
Oh, I
didn't want
know. Trust me.
to. Yeah, so I
Now that's
didn't want to.
something else. You're touching on something else, because there's also people that think that you all like should own your own funds. Can you speak to that?
Yeah, well, first of all, I actually owned Misty and Alti both
Yeah,
before I joined, and I was speaking about them, which is actually how
yeah,
Scott and Jay ended up reaching out to me, and
yeah.
I ended up divesting from both
Hmm.
um, because I didn't want to get handcuffed, and I do trade more actively, and I trade options pretty actively.
I figure. Yeah.
Jay does own these funds. He owns them in some investment vehicle that he has. So I
Hmm.
think that they actually don't show up under his own name, but they may show up under Zega, I think maybe, or something.
Yeah.
Which is something he addressed. I don't know how Mike Venuto's things are structured, but I know that he dollar cost averages into the funds. He may also have some, a family office, or I'm not exactly
Yeah.
sure what the structure. It's probably not a good idea for me to even speculate about how they
Well,
do it.
and
But
the
from my
way
private conversations, when that came up,
yeah,
they were like, "No, no, no, that's not the case."
yeah.
So I can't speak to that. And also, the filings
Hmm.
only apply to the named PMs on the associated fund. So
Yeah.
title as a bigger umbrella, I'm not a compliance guy, so I don't know exactly how that works. But
Hmm.
when they tell me we do own them and we invest in them regularly, I believe them. I know that Scott invests in some of these. Why the filings don't necessarily reflect it, I can't say. I know that Zega does show actually,
Hmm.
so that might be that. I can see here. Let's check this out actually.
Well, and my answer to that one, people, because people in the audience, I mean, they'll research everything. Like they do it
Hmm.
about me too. And I
Yeah,
figure, for liability purposes, I mean, you probably, I mean, some people have trust, some people have things maybe not even in their name. I totally get
yeah.
that.
Again, I
Yeah,
don't know whether it's the Zega. That's if Ulti
yeah,
alone, there's 220,000 shares of it.
yeah.
So, it's
Hmm.
what does that work out to? It's like 880,000 or something. Is that what we got?
Hmm.
Yeah. So, I mean, they do own it. I know that Mike Venuto told me that he dollar cost averages. I don't see their holdings. I'm not sure what that's all about.
Yeah,
The other thing I would also point out to folks is that title more broadly has, I think, 300. It's something like 300 funds at this point.
wow.
Um,
Oh, across like Defiance and all the others. Yeah,
so and YieldMax has 60.
yeah. A
Um,
fifth of
I
them.
I actually one of the things that I was looking into personally was,
Hmm.
is it possible that I can just auto invest into Biggie and then just spend Biggie distributions to meet expenses? I thought that would be kind of like a cool way to handle it. I
Yeah,
have to we're coming up to the end of the year. Gonna have to talk to an accountant about this just to figure out like what's the tax implications of doing that. Is that the best way for me to do it? But that I think would be kind of a cool way to do it. And I'm particularly interested in doing this for two reasons. One of them is that I'm a big believer in dollar cost averaging in general. And I kind of like to have a very systematic approach on that. The other is that I think we're in a better environment for writing covered calls in general than we have been for a long time. I gave a talk about this about a year ago. It was at the Crossroads Summit that was in Miami right about the same time last year. It was November of last year.
The Crossroads Summit.
Yeah. And one of the things I pointed out was I said, we've basically been in the worst possible environment for covered calls over the last couple of years for a couple of reasons. And if you want, I'm happy to talk about it. But
Sure.
So what were those reasons? One, rates. We went to ZIRP. And when you go to ZIRP, a couple things happen. ZIRP is not a natural state of affairs. We just talked about the fact the real rate of inflation is higher than the stated rate. Yep. And ZIRP meant that the treasury rates were substantially below even the posted inflation rates. We had the 10-year at 50 basis points. That makes absolutely no sense. And it creates a wild yield chase. It also does something else. It lowers what we call the forward. So in cases where you have a combo, long call, short put, low rates, increases the value of a put, all else equal, and decreases the price of a call. And that's because the cash balance that you would receive. So if you are like the single stock covered call ETFs are, you have collateral in the form of cash and equivalents earning interest, and then you have a synthetic to own the stock. Well, the interest that you're receiving on the collateral is zero, right? Yeah. So the forward goes down. And at the same time that this happens, because you have this massive yield chase going on, you jack valuations across the board. So even if yield spreads remain wide, so that could be yield spreads for whether it's high yield or whether it's investment grade or whether it's the corporate earnings yield, which is the inverse of PE relative to the risk-free rates. These things all get thrown completely out of whack. So all of a sudden, you're way better off just simply owning stock because those upside calls aren't giving you much, and valuations are just taking off, propelled by easy monetary policy. Well, the thing is, we were in a 40-year bull market for bonds, and ZIRP broke it because it brought inflation back. It brought inflation back to levels that we haven't seen in 40 years. Yep. And that bloom came off that rose, and now people recognize that. And we have absolutely broken a multi-decade downtrend in rates now. Now, I also happen to think, I agree with some others, in the investment world on this, that there is more of a functional cap to long-term rates this time around than there was in the late 70s and early 1980s when Paul Volcker came along and said, okay, we've got to stamp out inflation once and for all. And he didn't care whether rates were going to go to double digits to do it. Yep. Now, why is that? Because the U.S. federal government cannot fund its affairs if we go to double-digit rates. It's over. Right. The party is over.
The debt's
we had $9 trillion roll off at a sub 1% effective yield last year. And we have 15.5 trillion over the course of 3 years with an average rate, I think, of about 1.62% or so. I had done the math, but that was about the number. And that was all getting refied at 4. Well, 15.5 trillion times 4 minus 1.62 is a big number.
Oh, yeah.
Okay, now try to do that same math, except that you eventually have to roll all the debt, and there's 40 trillion of it now, plus whatever incremental deficit you run. Well, the math don't math when you do that at 10%. The party is well and fully over. We could have fixed this, back when they were thinking about passing a balanced budget amendment. That goes back to the Contract with America.
They should do that.
To the House days and Clinton in the White House. They came very close. They came within one vote in the Senate.
Yeah.
But now we've got real problems. And I think the implications for that are that there will be, this is not just something that I get and everybody who's watching you gets. Everybody in the Fed gets this too. Everybody in the Treasury also gets this. So what that means is that the Fed balancing their two mandates is going to sit there and say, okay, well, can we actually take rates to something that the government cannot pay? And the answer to that is they won't do that. So there will be some curve manipulation that comes along with it, is my guess. I mean, there could be other more extreme or drastic measures, probably not even worthy of talking about. But I mean,
Yeah.
I don't know, restructure it, default. I mean, but to me, it's going to be monetary. That's the most likely solution.
Yeah. Now, can you speak to on the current funds, like counterparty risk? We've never talked about that.
The counterparty for these it's the OCC.
Okay.
And the U.S. Treasury, which we talked about. But I
Yeah.
will tell you that the OCC. So for those who don't know, the OCC is the counterparty to every listed options trade, and the OCC is comprised of all of its member firms, and it is essentially as strong as its strongest member, which is to say that the OCC continues until all of its members have failed. Now, that's not to say that you don't have a cascading effect that could potentially happen where every financial firm on earth gets wiped out. And then how good is the OCC if JP Morgan is out of business, which is a clearing member, Goldman Sachs, Bank of America, Wells Fargo, every big financial firm in the world that is a member of it. And you can go to the Options Clearing Corporation and see the list of members. But the truth is that if you are worried about the OCC as a counterparty, by that point, you got way bigger problems.
Yeah.
Because that means that all the too big to fails have indeed.
Yep.
So I was in this business and asked to evaluate how well the exchanges and the OCC functioned during the GFC, because I lived through that.
Yeah.
I handled 25% of the liquidation of Lehman Brothers offshore accounts at the time. So I got a very good up close, and I was at Cantor Fitzgerald. We were a member of the OCC. So I had a very up close and personal look at what was going on. In 2008, two of the members of the OCC failed. Now, I just mentioned one of them, Lehman Brothers, right?
Yeah. Yeah.
And any guesses on what the other one was?
And in 2008, so you had Lehman Brothers was a failure. Oh, Bear Stearns.
Yeah, but Bear Stearns didn't technically fail.
They got bought by JP Morgan.
JP Morgan. So,
yeah.
No, the other one that failed, believe it or not, even though he never traded any options for real, Madoff was a member of the OCC.
Oh, wow.
So, in any case,
well, he wrote a lot of the rules, right? I mean, the NASDAQ and all. He was like one of the founders
of NASDAQ. Yeah. Of NASDAQ, not of the options. He did not understand options very well at all. He actually thought that he was telling people that he was doing essentially combos. Where he was really doing conversions. He was saying, I'm buying high quality stocks, and I'm selling the call and buying the put, selling the call to collect premium and buying the put to hedge.
I thought he wasn't even doing trades.
No, he wasn't. He wasn't.
Yeah.
So this is what he told people he were doing. And somebody said, wait a minute, isn't that just a conversion?
Yeah.
Which is what you call that trade. And he said, oh yeah, but I'm not using the same strikes. I call it a split strike conversion, which of course, anybody who knows anything about options says, well, we don't call them split strike conversions either. That's just collared stock. Yeah. And he wasn't actually trading them at all. There was nothing like that going on. But the interesting thing was that before 2008, the OCC had a credit facility to deal with the failure of members. And I believe, because like I said, I spoke at the World Federation of Exchanges about this in 2009 or 2010. It was right around all I remember was that took place around the time there was that volcanic eruption in Europe, because a lot of the people who were supposed to attend that conference didn't show. But there was like a $325 million credit facility that the OCC had going into 2008, specifically to deal with the failure of members. Lehman Brothers obviously was a very big bank at the time. They didn't draw down any of the credit facility, and they subsequently reduced it. Yeah. So I'm not concerned about the OCC as a counterparty, because, like I said, the OCC is a composite of basically all the largest financial institutions in the world. So for the OCC to fail, that means all of them must also have. So I think it's a pretty safe counterparty. Yeah. Not going to say they can't all fail. I mean, but I really, I mean, I I can hardly imagine the circumstances that would cause that. And like I said, the last thing that's going to matter, because that basically means the financial system cracked.
Yeah, exactly. Well, it's like I say when people say, "Oh, investing's risky," like the debt and all. Like, I
There's
mean,
some, yes.
if everything's going bankrupt, we've got much bigger issues. Like the debt. I mean, then you're talking the U.S. government, similar. Like then we got
Yeah.
much bigger issues.
Well, last time the market sold off, the dollar went down, not up. So the dollar is not considered a safe haven anymore. So if that's a barometer for people's faith in U.S. government, I guess they seem to have less of it. The dollar's not been particularly strong relative to, look at the Dixie. It's not like it's exuding huge confidence.
Yeah.
Unfortunately.
We'll do a two-part, just two-part. So do you post on your site, and this is a question from the audience, do you post on your site like the Greeks for the options trades that you do? Or would you consider
on the YieldMax site?
Yeah, would you consider that?
No, we do not. I don't think that has been considered.
Mm-hmm.
I don't think it should actually be necessary either, because the Greeks do change a bit with time. So why don't we take a look at an example? Maybe that'll be helpful from an illustrative point of view. Let's take a look at. See if I can go. Oops. See if I can find a trade. Today is Monday, so that's from Friday. So these puts. Okay, so I'm going to drag those in here. Oops, I'd hoped it was just going to give me the ticker. It didn't give me the ticker.
Mm-hmm.
Let's see if I can do this. Will that just give me the ticker? Okay, that's close to the ticker. This is actually an equity, so I'm going to put that in. All right. So the Greeks that would matter most to people who are probably thinking about what's going on here would be maybe the delta. They didn't specify. I mean, is anybody really interested in Charm? Vanna, Voma,
Vega.
No. Well, Vega, even Vega isn't really that meaningful in this context, because Vega is usually a sensitivity that we think about as options traders when we're thinking about the sensitivity as a function of the change in implied volatility. And that's usually more important when you're dealing with options that have a longer period of time to go until expiration.
He just mentioned data, not data.
Delta?
Yeah, delta and theta decay, and then implied volatility exposure.
Okay. Well, yeah. So let's do that then. Okay. So let's just do this. So calculating that, you have to, in order to back out the Greek, you must first establish what your theoretical value for the option is. Mm-hmm. So for the exercise I'm about to show you right now, the theoretical value I'm going to use is the midpoint of the bid-ask spread, which means that if I assume that the option was worth its bid price, then its Greeks are different than if I assumed it's at its ask price. So I'm going to choose the mid price. And the mid price it's going to use is the mid price right now and the mid price on Friday as of the close for this option. And so that way we can sort of work out the difference. Does that make sense?
Yep.
Okay. So let's just take a look at these. So right now I'm going to use so these are going to be the midpoint. Oops. What did I do? Sorry. Oh, not C1, C5. Okay. So this is an option that's in Ulti right now. We entered this position on Friday. Remember that these Greeks all need to be multiplied by the contract multiplier, which is usually 100. We're going to presume that it is 100 because this is not illuminated as an unusual contract. And then we would multiply that by the number of contracts. So we have 22,000 of those. And the multiplier is 100. So for each of those Greeks, it's going to be this times 2.2 million, right?
Mm-hmm. Can you zoom in just a little?
Oh yeah.
Yeah,
So
thanks.
yep.
There we go.
Hang on, I can make this bigger, and I will
Yeah,
do just like I did before. So let's just
perfect. Yep.
make this nice and big so everybody can get a good look at it. Okay, so that's the delta. And what do you notice about the Vega, by the way? It's de minimis, right?
Mm-hmm.
So you got 22,000 contracts. A one-click change in vol is going to move it, not by a whole lot. And the delta, this is in terms of shares. So if you want to know how much money deltas that is, then you can multiply that number times the last price in CLH. So I can say this is equal to, no, I want to do this. Take the equity, and I'll take the last price, and I'm going to multiply it by that. So that's essentially how many dollars of stock net short that options position is. That is as of today. Okay. However, if you were looking at it on the website, the number it would be showing you is not the number from today. It's going to be showing you the number from Friday's close. So today is the 24th. So that's the 21st. So now I'll show you what those numbers would be as of. So that's okay. So those are the numbers. Actually, it hasn't changed that much.
Yeah.
Why does it have no Vega for me? Did I put up? Doesn't recognize it as a historical. There we go. Okay. So there we have it. So you can see that these numbers have all changed a bit. In fact, actually, let's see by what percent each has changed. So this is moving around all the time. So theta has changed 24% since it would be on the website. So that would not really be that useful because you wouldn't really, I mean, it's not really real time, right?
Mm-hmm.
Delta in this case hasn't changed that much. Delta will change as a function of gamma. So, we could put that in if we wanted to.
Mm-hmm.
But I don't know that this has much utility. I think I would recommend instead, that you can probably just look it up and see.
Yeah. Yeah.
The other thing is that here's my guess on, why would somebody be interested in that? I mean, why would I be interested? I would be interested in real time in something like that because I would say, okay, well, what delta option were they selling?
Mm-hmm.
Right? So were they selling because what's interesting about delta is a statistical measure which can give us a crude estimate of the probability that that option expires in the money.
Yeah.
Now, the thing is that if I publish this number to the website on Friday night at midnight when everything gets uploaded, it may or may not be the same as when they actually executed the trade, but it might give you some sense. So it looks like they sold 22 delta puts in CELH on Friday.
Yep.
Were they 22 delta at the time that they executed? I don't know. We're most of the way through Monday, but if they executed these things on Friday morning, maybe they were 2 deltas off this way or that. So that's probably not a bad approximation. I can bring it up. I mean, is this something that people have a lot of interest in? I can bring it up to Josh or maybe some people on the team.
Mm-hmm.
I'm going to guess, though, that because these are numbers that move around, as you can see, one's down 7%, the other is up 24%. We're only a part way through another trading day since that even went up. It's not even like it's one full trading day since that got published.
True.
The information is stale pretty quickly, and it should be available to most people in real time.
Yeah.
I don't know. You could probably. I wonder if you can Google it. I mean,
Well, you know what I'm noticing? Because I used to nerd out on this stuff too. When I used Thinkorswim from my trades, it
Hmm.
shows all of that. But now if I just use the standard Schwab portal or Fidelity or even E-Trade, it doesn't show all of those. And I like to know that stuff. I like to know at least my delta and my theta, you know,
Well, the theta, I mean, theta is really the thing.
the
Well,
last
not
30 days, right?
yeah. I mean, I think
Yeah.
I mean, personally, I think it's valuable to know.
Hmm.
I do want to know what vol I'm selling. I'm I am curious about that. And I can actually calculate, I can estimate the value of options if somebody just tells me the vol and I know how many days there are to expiration.
Yep.
Because that math isn't terribly complicated. And you know, if ever I'm doubting it, I can always I since I got into the business, I've been using the same calculator, and I still, even with the spreadsheets, I
You said
actually
so,
do
yeah. Uh-huh.
still use that
Yeah, yeah.
all the
That's
time.
awesome.
Every day I pick that thing up. I've actually been wondering how long the batteries last because I
Oh,
don't
it's
even
not
remember changing.
solar. It's not like a solar
No, this
power.
is an HP12C. So
Right,
I have
right.
two HP12Cs. I have the original, which is actually dented. It actually had it in my pocket on the trading floor
Wow.
back in the late 90s. And it
Wow.
still works. And this is a platinum. And the only distinction that I'm aware of between the platinum and the regular HP12C is that you can actually program more lines into this one. So what that means is that if you use like one of Peter Carr's options pricing models and you have it coded in, you can't do one that accounts for dividends on the regular HP12C. So it's fine for SPX or OEX or you know, like a futures option or something like that. But if you need one that has a dividend assumption, you need, I think, like another 20 lines of programming code.
Hmm.
So that's what I have the platinum for. But I actually don't use it for modeling options prices anymore because obviously I got a lot of the tools for that. But I do use it for almost everything. Every time I'm trying to do math quickly, I usually grab that.
Yeah. Awesome. Well, great session. Thanks for all of your answers and transparency and thoroughness in the answers.
Oh,
Um,
I'm happy to. I mean, I look. You know, I mean, this is, and I think this is, you know, fairly important because I think every product out there um, should evolve and
yes.
improve through
Yeah.
time.
Oh yeah.
To the extent that these strategies have flexibility built into the way they're documented in the prospectus, like Ulti,
Hmm.
there are changes that are taking place. And some of those changes will do things like affect distributions. I'll give you a perfect example. You know, people who've been looking at the constituents of Ulti have probably observed that there are a couple names that have crept in recently that are not known to be super high implied volatility.
Hmm.
You know, Alphabet would be an example. I think I saw. Am I on Ulti? I am in Ulti. I don't see Costco in there. Costco was in there. It is still, yeah. So Costco, we got 75,000 shares of Costco in there. GLD is obviously gold is, um, you know, it's got volatility, but is it off the charts volatility? No. One of the things though that those underlying assets do have that is beneficial though for Ulti in the view of the managers at this point is that they are not necessarily as correlated with one another or don't have as much conditional correlation with one another. So what does that mean? If you have a diversified basket of stocks, 20 or 30 stocks, and they might not seem all that correlated at the moment. I actually, you know what, I can if you have one more second, I can
Go for it. Yeah.
yeah, let's just take a look at something.
Hmm.
I think you guys might find this interesting.
Yeah.
This will help explain why some of those products have been introduced. So it has been about 5 weeks or so since October 9th. October 9th was like Bitcoin really started to roll over in the beginning of October.
Right.
And Ulti's performance hasn't been great since then either. Now, part of that's understandable because strategy was in there,
Hmm.
coin was in there, Bitmine Immersion was in there. We had a mining company in there. But still, there's, you know, whatever, 30 stocks. I mean, it was not like it was 50% crypto, but it behaved. Anybody who's been owning Ulti or owning strategy or Bitmine Immersion, you know, maybe you felt like you had a diversified portfolio and you're wondering what the hell is going on here. I mean, I had Hood, maybe I had Hims and Hers. We had Hims and Hers in the book at that
I
time.
remember. Yeah.
Hims and Hers is a generic pharma company.
Yep.
And why does it feel like I'm just in one big crypto trade all of a sudden? Well, let's take a look at this. So if you looked at the correlation of all of the stocks that were in Alti as of October 9th, they were not that correlated. Now, this looks like the matrix because this is a matrix. This is what's called a correlation matrix. They don't memorize all the numbers. It's not important for what I'm about to show. What is important is the colors. So white, notice how all these numbers are 1 that I'm circling? That's because these are the pairwise correlations of the constituent stocks with each other. In other words, this one here, Rocket Lab, is perfectly correlated with Rocket Lab. Palantir is obviously perfectly correlated with Palantir, right? So this is just studying the relationship of these stocks with one another. Brown means basically they're not correlated. White means they're perfectly correlated. And some of these numbers, as you can see, are negative, like Open with CoreWeave. See, you can see this one here. That's a negative number. All right. Well, let's take a look at what happened since then. Okay. So that was the 5 weeks going into sort of when crypto rolled over. Let's see what has happened since that time. We'll just go to the present day. Does that look any different to you?
A little. Yeah.
A little?
I mean,
like it's all
first
white
glance.
all of a sudden.
Yeah. Oh, yeah. Yeah.
You know? I mean, Hims now has a correlation coefficient of 55 with Rocket. You know, I mean, what is going on here? Rocket and Palantir.
Oh, I see. Yeah.
Look at this. I mean,
yeah.
This whole thing turned white. So basically the benefits of a portfolio that these stocks were not behaving in lockstep with one another.
Yeah.
But suddenly they did. We went into a severe risk off environment, which meant that people started jumping high beta stocks with impunity. So Mike Venuto and Jay and Scott and the gang, they looked at this and said, okay, this is not an acceptable risk. It is not enough to simply say that these stocks aren't correlated to put them in. We need to put things in that don't bear a relationship and where the conditional correlation isn't there. You know, when people run a diversified portfolio, a portfolio manager will refer to this, and it's technically not a correlation breakdown. It's almost like a correlation break up, right? So all of a sudden correlations 10 to 1, and everyone's familiar with this. It's why stocks take escalator or the stairs up and the elevator down, because correlations rise. So when you start doing something like Costco, which is really a big grocery store, and you start putting things like gold in there, is it still possible that those things can track and that the correlations change? They can, they do. But when you have a lot of really high beta stocks in there, that tends to be a more nervous and fast acting class of investors. It's not 55-year-olds 401k money in Palantir and Hims and Hers. It's people who are more active investors, and they tend to respond that way. So if you're looking at the constituents, that's how an active manager decides, okay, we don't like how that behaved. We're going to make some changes. Those are some of the changes. Now, every change you make, the way I describe it, it's like squeezing a balloon. If I want less correlation, what do I have to give up to get that? Well, one of the things I might have to give up is, the amount of options premium that I'm collecting from a name. Alphabet doesn't have the same kind of implied volatility that Palantir does. And Costco doesn't have the same implied volatility that Hims and Hers does. And so if you're collecting smaller premiums, then the distributions you're going to be giving will probably go down as a function of that. But the stability of the underlying assets will probably rise. So one of the things we talked about at the very beginning of this was, what are the things that the fund manager can do inside of the RIC rules to lend more NAV stability, maybe at the cost of distributions? Well, one of them was, as I pointed out, choose calls that are further out of the money. We were looking at, this one put, for example, that was a 20 delta put, so low probability of assignment. So you can adjust the delta of the options that you're selling. But the other thing you can do is, pick stocks that just don't move around as much. And, then you don't get as much on the options. So these are the kinds of changes that are being implemented. And there's a lot of factors that go into stock selection. I mean, obviously, liquidity is one. Implied volatility is clearly one. Momentum is something that I know that they had looked at in the past and they intended to have. I have wondered from time to time because people have different measures of momentum. Are you talking about the 50-day? Is it above the 50? Is that count as momentum, or above the 200? Or are you looking at RSI? There are different technical indicators, and there are fundamental factors too. Are there downgrades that are coming from the sell side? All those things matter. So people will see that actively managed funds, including Alti, are going to, the constituents in the portfolio are evolving, and I would hope improving. I think they are.
Yeah.
And I hope investors feel the same way.
Hmm. Awesome. Well, sounds good. Thank you so much, Mike, for coming back on such short notice. And
I
for
appreciate the opportunity.
yeah, for everybody watching, any follow-ups, feel free to email. Check out YieldMax, and like, comment, and subscribe, and join Discord. And happy investing for the rest of the year.
Happy
All right.
Thanksgiving.
Yeah, happy Thanksgiving too. Yeah. Thanks everyone. Take care. And bye. All right, I'm gonna end the live.